This is question 3, part B and part C. So for part B, you're supposed to state and explain the method to calculate cost of sales, right? And the method is, of course, FIFO. So the first part, state, is FIFO stands for first in, first out. How do we explain the method? It assumes that goods purchased the earliest are sold first. All right, for the next part of the question, part C, you have a business who has an ending inventory of $31,500. However, the NRV is $29,800. Now, by now, you should know that we value inventory at the lower of cost or net realizable value. So we should take the lower amount, right? What we should have done is we should take $1,700, and this is what we call an impairment loss on inventory. Okay, so we should recognize the drop in value as an impairment loss on inventory, and of course this is what we call an expense. So your expense should increase by $1,700. However, the question is asking you, what happens if the business does not adjust the business inventory? That means the business just left the inventory at $31,500. It did not make this adjustment over here. It did not recognize this expense. So what happens to the profit, to the gross profit, to the profit, as well as to the equity in both years? Okay. We also know that the inventory was sold in 2018. Okay, so let's do first year first. So in the first year, of course, because the inventory is not sold, so there is no effect. All right, so this is quite straightforward. Okay, but once you move on to the profit, now remember, you are supposed to recognize an expense. What happened if you did not recognize this expense? Your expense will be understated. It will be lesser. If you have lesser expenses, your profit will be overstated by $1,700. Okay, and of course, if your profit is overstated, this will cause your equity for that year to also be overstated by $1,700. This is for the first year. For the second year, you have now sold the inventory. Okay, so when you sold the inventory, the cost of the inventory is overstated. All right, now we know that sales revenue, if we less our cost of sales, we will get gross profit. Okay, so cost of sale happens when we sell our inventory, right? Okay, so now we are selling overstated inventory. If we are selling overstated inventory, if this goes up, your gross profit will be understated. Okay, so in this case, your gross profit is understated by $1,700. And of course, this has an effect on your profit for the year, because your profit for the year will also be understated by $1,700. Okay, now next part is inventory. Sorry, next part is equity, right? Okay, so equity, you know that in your balance sheet, this is the format. You have your beginning balance, right? And then of course you will add your profit for the year, and of course you have less drawings and all, but I'm making it very simple for illustrating this example. Then you will have your ending equity, okay, ending balance, all right, or your total equity. Okay, remember in the first year, this equity was overstated. Okay, this is the ending equity. All right, so this is like your ending balance. When it comes over to this year, it becomes your beginning balance. Okay, so an overstated ending balance has become an overstated beginning balance. So this beginning balance over here is overstated from the previous year. And then now in this year, you have an understated profit. So add profit for the year, this is understated. So one is a beginning balance that is overstated, one is your profit that is understated. Both of them will cancel each other out. So in the end, there is no effect. All right, so I'm going to write here, there is no effect on the total equity.